What's up everyone, my name's Robbie. This is Robbie in Manila, and today we're talking about how to create a stock portfolio for beginners. I'm assuming you're probably new to the stock market if you're watching this video, and if so, welcome to the amazing world of investing. So this video is for beginners, and I'm going to go over how I create an investment portfolio if I was just getting started from scratch. Now instead of just going over one way to create an investment portfolio, I'm going to give you 5 different ways that you can go about doing this. Everything I'm going to go over today has diversification and risk management in mind, and it also has fees in mind. So let's figure out the best way to create an investment portfolio after the intro. Okay, so before we go over our first idea, just remember, I'd love to hear from you in the comments below after the video. Which of these 5 ideas I'm going over is the one that you prefer? So let me know, I'd love to hear from you. And so just 2 other little things I want to mention in this video before we move on. I am assuming that you have a broker in mind, or you know what broker that you're going to use when you start investing. If you don't for some reason, I have a video on the best brokers, I'll link it here. And I'll be linking a lot of stuff in the description below, so I'll also include that in the description below. Basically, just remember that you should have a broker that's not going to charge you fees on buying stock or buying an ETF or an index fund. The other thing I'm not going over is like what type of tax advantaged accounts are you going to use. So if you're going to use like a Roth IRA or an IRA or something like that. I do have videos. Again, I'll link those in the description below if you want to watch anything about that, but we're not going to go over that in this video. All right, so let's go over the first way to create an investment portfolio. And by the way, these are ranked based on easiest to hardest. So the first one I'm going to go over is the easiest way to do this. And so our first way to create an investment portfolio is to just have a one fund portfolio. This is by far the easiest way to have access to the stock market and invest in underlying stocks, but pay low fees and basically don't do any work. You just have to have one fund and you have good diversification. Now the fund could be an index fund or it could be an ETF. If you don't know the difference between the two, don't really worry about it too much. I do have a video I'll also put in the description below if you want to kind of figure that out, but an ETF or an index fund is probably going to be fine for you. Just remember, if you want to dollar cost average and add money in each month, depending on the broker, you might need to go with an index fund. Just check with your broker before you decide. The main thing you want to do is find either an ETF or an index fund that tracks an index, and then you're going to want to figure out which index it is, and I'll give you some ideas on some different ticker symbols. One way you can track the market is by tracking the S&P 500 index. So if you want to invest in ETFs that track these 500 different stocks and basically kind of average what these stocks do over time, then you can invest in the iShares IVV or in Vanguard's VOO. And by investing in those, you'll basically track what's going on in the S&P 500 index over time. If you instead want to invest in an index fund, you can go with Vanguard's VFIAX or Fidelity's FXAIX. Those both track the S&P 500, and either one would be fine. Now there are a lot of different ETFs and a lot of different index funds that track the S&P 500, so by no means am I saying these are the only ones to use, I'm just giving you an example. Now, if you do go with a different fund, just check the expense ratio, make sure it's not too high. And then what's great about this is you're going to get diversification because it tracks 500 different companies. Now, if you want to decide not to go with the S&P 500, which is the top 500 largest companies in the US, you could go with a total market ETF or index fund, which basically tracks the entire stock market. So this would actually be even more diversified than an S&P 500 index fund or ETF. It's going to track thousands of companies. And if you want to go with a total market ETF, you could go with Vanguard's VTI. If you want to go with an index fund, Charles Schwab has something called SWTSX. Again, either of these would be fine, and there's a lot of different total market ETFs out there, total market index funds out there for you to choose from. Okay, so that's our first way. It's the easiest way. You just add money into an ETF or an index fund every month. You could dollar cost average in, and it just grows and tracks the stock market. Our second idea is called a 3-fund portfolio. So there's a small problem with the first idea, and it's that it doesn't include what's called asset allocation. There's no other asset classes. It's only investing in stocks. But maybe if you want bonds, or if you want stocks that are not just, let's say, located in the US, but also international stocks, well, you might want to have a 3-fund portfolio. To create a 3-fund portfolio, I think it's always good to figure out your risk tolerance, which I will put in the description below, a link to a risk tolerance questionnaire for you. And you could take that and you could try to figure out how much you should be putting in stocks versus bonds. So while the 1-fund portfolio is like super easy, the 3-fund portfolio is also considered one of the easiest ways to get diversification and asset allocation. So like it says, you just have 3 funds. One fund would be a US domestic stock fund, only invests in companies in the US. The other would be an international stock fund, so you would get exposure to companies outside the US. And then the other one would be a bond fund, so you get exposure to bonds, which are actually less risky than stocks. Now, the amount that you would end up adding into stocks, bonds, or international would depend on your risk tolerance, which is why you should maybe take a risk tolerance questionnaire. But for an example, maybe if you're moderately aggressive, just off the top of my head, maybe you would put 60% into domestic stocks, 30% into international stocks, and maybe 10% into bonds. I'm not going to go over exactly how to create a 3-fund portfolio because I have 2 videos on that, so I'll link them in the description below, but I have a video on how to do this with Charles Schwab ETFs and index funds and with Fidelity. So our third idea is an all ETF or an all index fund portfolio. So I really love the all index fund or all ETF portfolio because it allows you to kind of have this feeling that you're still having a lot of control over your portfolio because you're looking through different ETFs, different index funds, and still kind of picking the investments you're going to use. It's great for people who don't want to delve into stocks, learn how to do the research and things like that because it can get overwhelming. And it's a lot easier to figure out a mix of different ETFs that are already diversified or a mix of index funds that are already diversified than it is to find just individual specific stocks. There's thousands of ETFs and index funds that you can choose from. So you can create a nice portfolio with maybe 10 ETFs or 10 index funds or 20 or whatever you want to. And you can basically say, well, if you're a conservative investor, you'll go with more conservative allocation. If you're more aggressive, you can pick some more speculative stuff. Some general examples of this are, for example, if you want to just invest in like the NASDAQ, you can invest in triple Q, which is ticker symbol QQQ. If you wanted to invest in the largest 1,000 companies in the US, you could invest in IWB. You could find ETFs or index funds that only invest in growth stocks or in value stocks or in large companies or small companies or a mix of those. For example, if you want large companies but that are value stocks or small companies that are growth stocks, there are ETFs and index funds that just specifically focus on those things. You could even have some positions in something called smart beta, which invests in stocks only experiencing certain factors. So an example of this is if you want to invest in momentum stocks, there's an ETF called MTUM or XMMO, which invests in like mid-cap stocks that are experiencing momentum. Something like that may be kind of a smaller part of your portfolio, or it could be kind of a decent size, depends what you want to do. And the same would go for an ETF that's called a managed ETF, where there's an actual investment manager who's picking stocks on the behalf of the ETF. And an example of this is ARK. So ticker symbol ARKK is one of them. You may have heard of them. They invest in innovative companies and they've had a great track record, but you would want this to be maybe a smaller portion of your portfolio. So on to our fourth idea, the core and satellite portfolio. To me, the core and satellite portfolio is like the best way to create a portfolio that has stocks, but also has like a core position that's in like just a main index. In my opinion, for most investors, when you're just starting out, you're not gonna go out and pick like 15 stocks or 20 stocks like right off the bat. You wanna do your research and it's gonna take some time to find the right stock. So core and satellite portfolio is the perfect way to develop a portfolio that has both stocks and some money in an index fund or an ETF. So core and satellite portfolio would look kind of like this. You start off with like an ETF or an index fund with your main position, like one of the ones we talked about before, like IVV that invests in just like the S&P 500 index. Let's say the next month you're gonna say, I'm gonna put some money now into a stock that I found. So you're gonna either take money out of your index fund, your ETF, put into your stock, or maybe you're dollar cost averaging and investing money every month. So the new money might go into a new stock. Maybe by month 7, you have a bunch of different stocks with your core fund and it looks like this. And so percentage wise, you might say like, okay, here's an example with FXAIX, which is the Fidelity fund that I talked about. You start off with 100%. Maybe by month 2 you decide that you like Microsoft and you want to add some money to it. And so what you could do is you could take FXAIX, reduce it from 100% to 95%, then you put 5% into Microsoft. And over time, you're going to have a nice diversified portfolio where you're going to have this core and then these satellite positions. And that's why they call it a core and satellite portfolio. So our fifth and final idea is to create an all-stock portfolio. So of course, in order to create an all-stock portfolio, you're going to have to do some research to find the best stocks to invest in. And so you might want to start thinking about the following. So how many stocks should you invest in? So in my opinion, maybe 15 stocks would be a minimum, maybe 20 stocks would be good as well. Getting above 20 stocks is hard to basically keep track of all the companies that you have. When you have less than 15 stocks, it starts getting a little too concentrated for a portfolio. So to diversify a portfolio of 15 to 20 stocks, you may want to go a little bit deeper and say, well, what type of sectors are you investing in? If you have 15 stocks and they're all in the real estate sector, well then you're kind of concentrated in the real estate sector, which might not be a good thing. So having some stocks in healthcare, real estate, information technology. So basically you spread the different companies around in your portfolio so that you have less exposure to just one sector. This is just another way of further diversifying your portfolio. Another question you may want to ask is, do you want to invest in growth stocks or more dividend-paying stocks? Dividend-paying stocks could potentially be large blue chip companies that have been around a long time. They may have less risk, less downside, but they may not have the upside growth potential as a growth stock does. Just remember, growth stock can potentially also have more volatility, but they could make more money potentially down the road as well. Of course, you can always invest in both growth and dividend-paying stocks, no problem. You may also think about whether you want to invest in large companies, mid-sized companies, or smaller companies. Oftentimes, investing in smaller companies can potentially have more volatility, but also potentially have more growth. Large companies can sometimes be these large cap companies that have been around a while that maybe aren't going to grow that much, but are still going to be pretty stable. And speaking of larger companies, when you're starting out, you may want to decide if, because you're a beginner and you're just kind of learning here, do you want to invest in kind of the largest, most popular companies? This would involve only investing in companies that are in like maybe the FANG stocks, or maybe good dividend paying companies, or just companies that have good brand names that have been around for a while. And if you're not sure what the FANG stocks are, they're basically the tech giants: Facebook, Apple, Amazon, Netflix, Google, which is called Alphabet on the stock market. And these are stocks that you may want to take a look at to invest in to have some exposure to the FANG stocks. Other stocks that have been established for a while that have good brand names might include, Starbucks, McDonald's, Visa, Procter & Gamble, JP Morgan Chase. So there's all these different companies that you've heard of. They've been around for a while. They may or may not grow a lot in the future, but they're probably more stable and less likely to have a large decline in your portfolio. Then you could also mix in some bigger companies, maybe that have potential growth, like Nvidia or Tesla. Now, if you don't just want to invest in these bigger companies that have been around a while and you want to get into the research and understand the financials of the companies, then you could look at the following things. I think it's good for beginners to understand what earnings per share is and also net income. I also think it's good to have an understanding of what's called the market ratios. So this might include PE, or the price to earnings ratio, price to book ratio, or the PB ratio. Also, dividend yield is a good one to understand. There's also something called profitability ratios. So this would be like the operating margin of the company or the gross margin of the company. And then there's something called the leverage ratio, which might include debt. So this would be like a debt to equity ratio. And so those are just a few ratios you might want to learn about. Of course, there's a lot more. And so that's it. That's all we have for the day. So if it was just me and I was going back and trying to learn this stuff and start again, I'd ask myself if I'm interested in buying individual stocks right now. And if I'm not, I'd just go with a 3-fund portfolio or an all ETF or index fund portfolio. And if I wanted to invest in individual stocks, but I didn't really understand them yet, I would maybe go with a core and satellite portfolio. Only if I knew a decent amount of finance and accounting, and maybe that was my profession or the industry I worked in, only then would I go with like an all stock portfolio. And so thanks everyone so much for watching, and please again, leave a little comment, let me know which of these 5 different portfolio ideas you like the best. And hit the like button and subscribe if you want to see future content like this, and we have another video coming up on the end screen, so you should probably hit that right now.